Every year, billions of dollars in receivables go unpaid. A customer files for bankruptcy. A distributor ghosts you after net 60. An international buyer defaults, and you have no recourse. For most businesses, that is just the cost of doing business. But it does not have to be. And in this video, I'm going to show you exactly how trade credit insurance works, who it is for, what it actually covers, how much it costs, and why the companies that use it sleep better at night. Let us start with the problem. Your accounts receivable is probably one of the largest assets on your balance sheet. For many manufacturers, distributors, and service businesses, it represents 30, 40, even 50% of total assets. But unlike your inventory, your equipment, or your real estate, it is completely unprotected. If a customer cannot pay, you lose the sale and the goods. Depending on your margins, it can take 10 or 20 more sales just to break even on that one loss. And if that customer represents a significant portion of your revenue, the impact can be devastating. This is the risk most CFOs quietly carry on their books, and most of them do not realize there is a product specifically designed to eliminate it. So what is trade credit insurance? Trade credit insurance, or also called accounts receivable insurance or debtor insurance, is a policy that protects your business when a customer fails to pay. The three primary triggers are insolvency, meaning the buyer has filed for bankruptcy or been declared insolvent; protracted default, meaning the buyer simply stops paying without a formal insolvency event; and in some policies, political risk, where a foreign government action prevents payment. Here's how it works in practice. You apply for a policy and the insurer reviews your customer portfolio. They assign credit limits to your key buyers, essentially telling you how much exposure they are willing to insure on each account. You pay an annual premium, typically somewhere between 0.1 and 0.5% of your insured turnover, depending on your industry and the risk profile of your buyers. And if a covered customer fails to pay, you file a claim and the insurer reimburses you, typically 80 to 90% of the invoice value. It is not complicated, but most businesses have never been told it exists. Now, who actually uses trade credit insurance? The short answer is any business that sells on credit terms. That means net 30, net 60, net 90, any arrangement where you deliver goods or services before you receive payment. Specifically, trade credit insurance is widely used by manufacturers extending open account terms to their distribution networks, exporters selling into international markets where buyer creditworthiness is harder to assess, staffing and professional services firms with concentrated client exposure, and distributors operating on thin margins who cannot afford to absorb a significant bad debt. One thing worth noting, this is not just for large companies. Many insurers have products specifically designed for small and mid-sized businesses. If you have annual revenues above a few $1,000,000 and you sell on credit, you are likely insurable. Now here's where it gets interesting, because most people think of trade credit insurance purely as protection, but the companies that get the most value from it use it as a growth tool. Here's what I mean. With an insured receivables book, your bank is likely to lend against it at a higher advance rate and a lower cost. That means more working capital to fund growth. Your sales team can offer more competitive payment terms to win new customers, because the risk of extending credit is covered, and you can pursue markets or customers you would otherwise avoid, international buyers, new sectors, larger accounts, because the downside is insured. The policy also gives you access to the insurer's credit intelligence. Most trade credit insurers monitor the financial health of thousands of companies. If a buyer you're extending credit to starts showing signs of stress, you get early warning before it becomes a loss. So what does it cost? Premiums vary based on your industry, your geography, the credit quality of your buyers, and the structure of your policy. But as a general benchmark, most policies fall in the range of 0.1 to 0.5% of insured revenue per year. On $10 million of insured receivables, that might be $10,000 to $50,000 annually, to protect an asset that could otherwise be wiped out by a single bad debt. For most businesses, the math is straightforward. Finally, how do you get a policy? Trade credit insurance is a specialty line. It is not something you buy through your commercial property and casualty broker. You need a specialist. A good trade credit broker will analyze your portfolio, help you understand what is insurable and on what terms, approach the market on your behalf, and structure a policy that actually responds when you need it. If you are carrying unprotected receivables and you have never explored trade credit insurance, you are taking on risk you simply do not have to carry. In the next video, we are going to cover political risk insurance, what it is, what it covers, and why it has become increasingly relevant for any company with international exposure. Subscribe so you do not miss it. And if you have questions about trade credit insurance, drop them in the comments below. We go through every single one,